As we check the live markets right now, Rivian Automotive Inc. is trading at $14.88, showing a fractional gain of 0.034%, effectively flat for the intraday session. If you are looking at this on your Fidelity mobile app or glancing at the ticker tape on your interactive brokers platform, you might see this lack of movement as a sign of disinterest. You might think the market has forgotten about the electric adventure brand. But do not be deceived by the stillness. A stock trading at $14.88 with this level of compression is often like a compressed spring. The market is currently in a standoff, caught between the expectation that Rivian is just another cash-burning EV startup destined to struggle in a high-interest rate environment, and the emerging reality that Rivian is quietly transforming from a hardware manufacturer into a software-defined powerhouse backed by one of the largest legacy automakers on the planet. This flatline today is not apathy. It is the calm before a definitive directional break as investors digest the long-term implications of the Volkswagen joint venture and the upcoming R2 platform. When you see Rivian sitting at $14.88, you're looking at a company that is fundamentally different from the one that IPO'd at over $100. The expectation back then was pure hype. Investors wanted the next Tesla stock. The reality today is a battle for operational efficiency. The stillness in the price action today reflects a market that is waiting for proof of execution. They know the R1T and R1S are beloved by owners. Customer satisfaction scores are off the charts, but they are waiting to see if Rivian can actually make money on every vehicle they sell. The current flatness suggests that the sellers who wanted out are gone, and the buyers who want in are waiting for the next gross margin data point. This equilibrium is fragile. A single headline about R2 production timelines or a shift in EV tax credits could shatter this calm instantly. If you are managing your own portfolio via SoFi Active Investing or using Robinhood stock trading to speculate on high-growth tech, you have to look past the daily noise and understand the structural shift happening in Normal, Illinois. The recent Peregrine project, the massive re-engineering of the R1 platform, was not just a facelift, it was a complete gut renovation of the vehicle's internal architecture to strip out cost. The expectation was that Rivian would just keep burning cash to grow volume. The reality is that they shut down the factory to simplify the wiring harnesses, remove hundreds of parts, and switch to cheaper, more efficient suppliers. This is the unsexy work of manufacturing that doesn't make headlines but makes profits. The market is currently discounting this. They see the factory shutdown as lost production. The deeper reality is that it was an investment in positive unit economics. If that bet pays off, the stock at $14 is valuing the company as if it will never be profitable, which creates a massive asymmetry if they flip to green. I want you to take a moment and comment below. Have you seen more Rivian R1Ts or R1Ss in your neighborhood lately? And do you think the brand appeal is strong enough to steal customers from the Tesla Model Y when the R2 launches? I am genuinely curious to gauge the brand visibility on the ground in your area. Let's talk about the Volkswagen deal because this is the cornerstone of the bull reality. When Volkswagen announced they were investing up to $5 billion into Rivian, the headline was about the cash. The expectation was Rivian needs money, Volkswagen has money. But the reality is about the software. Volkswagen, for all its manufacturing might, has struggled immensely with vehicle software. Their internal units have faced delays and bugs. By investing in Rivian, VW is essentially admitting that Rivian's zonal network architecture and software stack are world-class. They are paying to license the brain of Rivian. This changes the valuation model entirely. If Rivian becomes the Android of EVs, licensing its OS to other manufacturers, it is no longer just a car company with low margins, it becomes a tech platform with software margins. The market is skeptical. They are waiting to see the ink dry and the first joint models roll out. But at $14.88, you are paying for a struggling car maker and getting a potential software monopoly for free. For those of you looking for investment help or using Fidelity wealth management services, your advisor might be hesitant about Rivian because of the cash burn narrative. And it is true. Building car factories is historically one of the best ways to set money on fire. However, the reality is that Rivian has effectively pre-funded its growth through the R2 launch with the VW capital. The bankruptcy risk that plagued the stock earlier this year has been significantly de-risked. Now the risk shifts to execution risk. Can they build the Georgia plant on time? Can they ramp R2 without the quality issues that plagued R1? This shift from will they survive to can they execute is a major graduation for the stock, yet the price is still languishing in the teens. This divergence is where the opportunity lies for the self-investing crowd who are willing to do the homework. Let's delve into the product roadmap. The R2 is the make-or-break vehicle. The R1 is a six-figure luxury truck. It's fantastic, but the market for $90,000 trucks is limited. The R2 is targeted at the $45,000 price point, aiming directly at the heart of the market, the Tesla Model Y. The expectation is that entering the mass market will destroy Rivian's margins because they can't compete with Tesla's scale. The reality is that the R2 is being designed from the ground up for manufacturing ease. They're using high-pressure die castings, structural battery packs, and the simplified network architecture I mentioned earlier. If Rivian can transfer the cool factor of the R1 to a vehicle that costs half as much while maintaining positive margins, the demand is virtually uncapped. We saw hundreds of thousands of hand raisers when they revealed the prototype. The demand is not the issue. The cost to build is the issue. We also have to discuss the Amazon partnership. For a long time, Rivian was seen as Amazon's delivery van maker. The expectation was that this exclusivity was a golden handcuff. The reality was that it was a golden handcuff. Amazon wasn't taking delivery fast enough, and Rivian couldn't sell the vans to anyone else. That exclusivity has ended. Rivian is now talking to AT&T, DHL, and other massive logistics fleets. The commercial van market is less sexy than the consumer truck market, but it is sticky and predictable. If Rivian can diversify its commercial customer base, it adds a layer of stability to the revenue that balances the volatility of the consumer side. The market has largely ignored this shift, focusing only on the consumer EVs, but the commercial potential is a sleeping giant within the valuation. If you are using Interactive Brokers trading tools to analyze the order flow, you might see that Rivian often moves in sympathy with the broader risk-on trade. It correlates with high-beta tech. But recently we've seen it decouple slightly from Tesla. When Tesla stock drops on robo-taxi doubts or margin compression, Rivian doesn't always follow. This suggests that investors are starting to treat Rivian as its own entity with its own drivers rather than just a Tesla sympathy play. This decoupling is healthy. It means the stock is finding its own floor based on its own fundamentals. The competitive landscape is brutal, and we cannot ignore it. You have the Cybertruck, the Ford F-150 Lightning, and the Silverado EV. The expectation was that the Cybertruck would kill the R1T. The reality is that they appeal to completely different demographics. The Cybertruck is a brutalist statement piece for the tech-forward, often polarizing. The R1T is the Patagonia vest of trucks. It appeals to the outdoor enthusiast, the quiet luxury buyer, the person who wants capability without the aggressive aesthetic. Rivian has successfully carved out a brand niche that is distinct from Musk's empire. This brand elasticity is an intangible asset. People like Rivian. They root for the company. In the consumer world, that goodwill is worth billions if nurtured correctly. For the aggressive traders on the Robinhood app or those using Robinhood Cash Management to hold dry powder, the options market on Rivian implies significant volatility ahead of upcoming earnings. The implied moves are often double digits. This is because the company is at an inflection point regarding gross profit positive. Management has promised to reach a modest gross profit by the end of 2024. If they hit this metric, meaning they sell the car for more than the cost of the parts and labor, it validates the entire business model. If they miss it, the stock could retest single digits. This binary event is keeping the price pinned at $14.88 today. Nobody wants to make a big bet right before the scorecard is revealed. Let's look at the charging situation. Rivian was one of the first to adopt the NCAS or Tesla charging standard. By gaining access to the supercharger network, they neutralized their biggest disadvantage: charging anxiety. The expectation was that this would commoditize the charging experience and hurt Rivian's own Adventure network. The reality is that Rivian is continuing to build its own chargers in